IQVIA, the company most investors have never heard of, yet one that sits at the heart of nearly every major drug approval in the world.
It is the world's largest contract research organization, employing nearly 90,000 people to run clinical trials and provide data analytics to pharmaceutical and biotech companies.
IQVIA was formed in 2016 through the merger of IMS Health, which had been the dominant pharmaceutical market data provider, and Quintiles, which was the largest standalone CRO.
That combination is what makes IQVIA structurally unique. No other company in the world packages proprietary drug market data with full-service clinical trial management at this scale.
The business operates across two primary segments: technology and analytics solutions, which licenses data and software to pharma companies, and research and development solutions, which manages trials.
The R&D Solutions segment represents over half of total revenue. When a pharmaceutical company wants to run a Phase 3 trial across 20 countries, they often call IQVIA.
IQVIA maintains one of the largest proprietary healthcare databases in existence, covering billions of anonymized patient records and prescription events spanning more than 100 countries.
That data gives IQVIA a second moat beyond CRO execution. Pharmaceutical companies embed IQVIA datasets into their commercial planning and forecasting workflows, creating significant switching costs.
A key financial metric for IQVIA is the revenue backlog. With roughly $29 billion in contracted future work, the company has exceptional forward revenue visibility compared to most industrials.
The book-to-bill ratio, new contract awards divided by recognized revenue, is another critical number. A ratio consistently above 1 signals the pipeline is growing, not shrinking.
On the competitive radar, IQVIA scores highest on proprietary data assets and global reach. The data library took decades to build and cannot be replicated by a new entrant from scratch.
The closest CRO competitors are Icon, Charles River Laboratories, and Syneos Health. None of them combine the data analytics platform with clinical execution at IQVIA's scale.
IQVIA operates across over 100 countries, with investigator networks on every inhabited continent and the logistical capability to move clinical supplies globally across regulated environments.
CEO Ari Bousbib has led the company since the IMS Health merger, having previously run IMS Health after his years at United Technologies. His tenure spans the full transformation of the business.
Under Bousbib, IQVIA has steadily grown its technology revenue mix, which carries higher margins than pure clinical services and provides more recurring, predictable cash generation.
Adjusted EBITDA margins sit around 22%. That reflects the labor-intensive nature of clinical research, but also the premium IQVIA earns from its data and technology services.
IQVIA does not pay a dividend. Cash generation is directed toward debt reduction, acquisitions that add new datasets or geographic coverage, and share repurchases over time.
The long-term thesis for IQVIA is straightforward. Pharmaceutical R&D spending grows over time as companies discover more targets, run more trials, and rely more heavily on outsourced research expertise.
IQVIA captures that outsourcing trend as a primary beneficiary, sitting at the intersection of the data infrastructure and execution capability that modern drug development depends on.
The combination of a proprietary data moat, a massive clinical execution network, and decades of pharma relationships makes IQVIA a difficult business for competitors to displace from its position.
IQVIA delivered a clean Q1 beat and the stock fell 5%. Adjusted EPS came in at $2.90 versus consensus of $2.82, a small but clear beat. Revenue of $4.151 billion topped estimates by 1.2%. Management raised the full-year EPS guidance. Investors sold anyway because the operating margin compressed 5.5 points year over year. This is charged alpha. Let's break it down.
For context, IQVIA is the world's largest clinical research organization and healthcare data analytics company, with a market cap of $28.7 billion. The two-segment structure was just reorganized this year. Commercial Solutions combines the legacy data and contract sales businesses. Research and Development Solutions runs clinical trials. Together, they serve every major pharmaceutical and biotech company.
The headline numbers were better than feared. Adjusted diluted EPS of $2.90 grew 7.4% year over year, and exceeded the high end of company guidance. GAAP EPS came in at 161. That 13% gap reflects intangible amortization and ongoing restructuring charges from the post-merger integration that has run for nearly a decade.
Revenue of $4.151 billion grew 8.4% on a reported basis and 6% on a constant currency basis. The acceleration from prior quarters reflects pharmaceutical research and development spending stabilizing after 2 years of biotech funding volatility. Large-cap pharma sponsors continued to expand outsourcing budgets despite macro uncertainty.
The newly structured Commercial Solutions segment delivered $1.754 billion in revenue, up 11.6% reported and 8.5% on a constant currency basis. That segment combines pharmaceutical data licensing, software offerings, and contract sales work. Demand for therapeutic area data and commercial planning analytics from pharma customers is the main driver here.
Research and Development Solutions came in at $2.397 billion, up 6.2% reported and 4.2% constant currency. That deceleration signals that the late-stage clinical trial cycle is normalizing rather than expanding, even with the record backlog. The growth gap between segments will be the most watched dynamic for the rest of 2026.
The most important business metric was the backlog. Total contracted backlog reached a record $34.2 billion. The next 12 months conversion increased 7.6% to $8.9 billion. Net new bookings of $2.5 billion produced a quarterly book-to-bill of 1.04 times. Trailing 12-month book-to-bill is 1.11. Demand is healthy.
But the margin story is what dropped the stock. Adjusted operating margin came in at 13.9%, down 5.5 points year over year. Adjusted EBITDA margin was 22.5%, with EBITDA of $932 million, up just 5.5% year over year against the 8.4% reported revenue growth. Margin compression is real.
Management attributed the compression to mix shift toward lower margin segments and continued investment in AI-enabled service offerings. Free cash flow grew 15% year over year to $491 million. Operating cash flow grew 9% to $618 million. So cash generation is intact, even as reported margins compress.
Capital allocation remained measured. IQVIA does not pay a dividend. The company has been deploying free cash flow to opportunistic share repurchases and continued debt reduction. Total debt sits at $16.174 billion against just under $2 billion of cash. Net debt of $14.2 billion is a major balance sheet item that constrains strategic optionality.
IQVIA trades at 22.4 times trailing earnings and just 13.2 times forward 2026 estimates. EV to EBITDA approximately 11.6, price to sales 1.8. The valuation has compressed meaningfully. A year ago, the forward multiple was closer to 17 times. Margin compression is the structural reason for the derating.
Wall Street's positioning is constructive. The consensus breakdown is 16 buy ratings, 6 holds, and 0 sells. The average price target is around $215, implying 27% upside from current levels. TD Cowen and Barclays both upgraded IQVIA in March. Evercore ISI maintained outperform. The cautious voices are worried about margin trajectory, not demand.
The forward guidance was the bull case validator. Full-year adjusted EPS guide was raised to $12.65 to $12.95, implying 7.4% growth at the midpoint. Full-year revenue guidance was reaffirmed at $17.15 billion to $17.35 billion. EBITDA guidance was reaffirmed at $3.975 to $4.25 billion.
That guidance combination reads as confidence in the year, but caution on the back half cadence. Reaffirming revenue and EBITDA while raising EPS implies management expects continued margin pressure, offset by the accretion from cost savings and lower share count. Investors prefer raises across the board, which is part of the negative reaction.
The bull case rests on 3 pillars. First, the backlog. $34 billion in contracted work provides multi-year revenue visibility. The conversion ratio improving year over year confirms that backlog is being executed, not piling up dead. R&D Solutions remains the dominant CRO franchise globally.
Second, the data moat. IQVIA's proprietary healthcare dataset covers prescription, claims, and patient-level information across hundreds of millions of records. Pharmaceutical companies embed this data into their commercial planning workflows, creating significant switching costs. The commercial solution segment captures that recurring revenue.
Third, AI-enabled offerings. Management called out the rollout of AI-driven CTFS site payments tooling, plus broader AI integration into clinical trial design and execution. If IQVIA can convert AI from a cost driver to a revenue accelerator, the operating margin compression reverses by 2027.
The bear case starts with the margin compression itself. 5.5 points of operating margin decline in a quarter is not noise, it is structural. Whether driven by mix or by AI investment spend, that erosion takes multiple quarters to recover. The market does not have visibility into when margins re-expand.
Second concern, the book-to-bill cooling. Quarterly bookings of 1.04 are below the trailing 12-month average of 1.11. That gap suggests current quarter sponsor demand is moderating from peak levels. R&D Solutions' constant currency growth of just 4.2% is the slowest among the segments.
Third, the valuation has compressed for a reason. IQVIA carries $14 billion in net debt, ongoing restructuring expense, and a wide gap-to-adjusted gap. Investors paying 13 times forward earnings are implicitly pricing structural margin pressure as a permanent feature, not a transitional one. The reset can deepen if Q2 disappoints.
IQVIA's competitive set is the contract research organization industry plus broader pharmaceutical services. ICON is the closest pure-play comp focused on global clinical trial execution. MedPace is the smaller, faster-growing specialist. Thermo Fisher's PPD division competes through scale. LabCorp competes in lab services. Veeva is the SaaS-heavy software comp.
Versus ICON, IQVIA trades at a slight premium on EV to EBITDA but offers a deeper data and analytics franchise. ICON is more pure-play CRO. Versus MedPace, IQVIA is the scale player. MedPace is the higher-growth, higher-margin specialist. The choice between the names depends on whether an investor wants stability or operational leverage.
Versus Veeva, the comparison highlights the data software divide. Veeva trades at a much higher multiple as a pure SaaS pharma vertical software company. IQVIA carries clinical trial execution risk and the lower margin services exposure. Investors pay a Veeva premium for capital-light recurring revenue. IQVIA is the heavier footprint scale operator.
Options activity around the print was modest. Put-call ratio near 0.92 reflects neutral positioning with some hedging into Q2. Implied volatility ticked up post-print and remained elevated into the next earnings cycle. The options market is pricing real uncertainty about whether the margin trajectory bottoms or worsens.
Bottom line on IQVIA. The underlying business is healthy, the backlog is at record levels, and management raised the EPS guide. The stock fell 5% because operating margin compression dominated the narrative, and the back half guide was reaffirmed rather than raised. Margin reset versus margin recovery is the central debate for the rest of the year.
For long-term investors, IQVIA at 13 times forward earnings with a 7% EPS growth profile and a record backlog is a credible value entry. For short-term traders, the next 2 quarters need to demonstrate margin stabilization before the multiple re-rates. Track adjusted operating margin and quarterly book-to-bill into Q2 as the key catalysts.
Financial data and charts sourced from Financial Modeling Prep. Charged alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.